Welcome to Real Estate Investing for Professional Men and Women, the podcast that guides professionals to financial prosperity. Join our community and let's start building your wealth. Here's your host, Gary Wilson.
Hello, everyone, and welcome to this week's Real Estate Investing for Professional Men and Women, the podcast for those of us who are professionals, typically in our fields, often have a business already or multiple businesses. And the way we invest is we're not using all that. You don't have to have cash. You don't have to have credit. We're not using all that no money now stuff. We do use those strategies, okay, but we don't rely on them exclusively to our investing. The fact is, when you can operate with cash, you're always going to get better deals. The trick is, how do you get there? So this is part of what this is about. We generally buy better properties. You know, the old saying, crappy properties, crappy tenants, good properties, good tenants. So we buy right in the right areas. We also do joint ventures together, things like that. So if you haven't been to myinvestmentservices.com, go ahead and go over there, click on the members tab and look in there and see if you want to join up and be a member. It's a great community, you know, several thousand strong across U.S. and Canada. In fact, I've taught over 20,000 people how to do this. And if you're listening to the podcast and you never subscribed, please go ahead and do so. It's on Stitcher, iHeart, Radio, iTunes. I mean, it's 75 different channels. Just go ahead and subscribe. And from time to time, they'll give you some, free books, free reports, things like that. So in any case, welcome aboard. And we got a special guest today, Josh Friedenson's in one of my mastermind groups, fellow investor. And he's done a lot of work in the multi-unit sector and also mobile homes. And he's looking to exit that perhaps. So let's introduce Josh. Josh, welcome aboard, man. I appreciate you taking your time to do this and serve your fellow man,
Thanks for having me.
Yeah. Hey, if you wouldn't mind, just to get things started, tell people a little bit about yourself, brief history, or bring some context to what we're going to talk about. So when we dig into the details, people will more likely resonate with you and maybe perhaps see a little bit of you and themselves,
Yeah. So I grew up I grew up in Dallas-Fort Worth. My family's New Yorkers, and we kind of migrated over to Dallas-Fort Worth. I went to the University of Texas, studied chemical engineering. And the main reason I studied chemical engineering is because I wanted salary stability. I wasn't necessarily considering the salary growth. It was more stability out of college. And took my first job, making $60,000 a year as a chemical engineer in Atlanta, Georgia. Didn't know anyone out here, knowing that I wanted to start kind of a side hustle, entrepreneurial business, and work my way out of it. I met my business partner about 6 months in of being frustrated being an engineer. And him and I connected, and we're just out the gates, just trying to get something started. We tried some .coms, we tried some software companies. We tried all sorts of different crazy things. And in the meantime, it was 2008, 2009. The recession was kind of in the midst. Atlanta got destroyed. Single family values got hit pretty hard. So I convinced him, he was living in DC at the time. And I convinced him to buy a single family house with me down here. And I basically found it, with really the only person I knew in Atlanta. He was a realtor. And I did all the renovation work and leased it. And he had done a bunch of single families with his dad growing up. And so he had enough kind of structural background to kind of provide insight. And 3-4 months later, it went so well that we did another one. And 3-4 months later, we did another one after that. At that point, we were kind of tapped out of our own cash. So we decided to call up some college buddies and people that we knew in the community and raise some money and do a small apartment deal. In the meantime, we're still working our full-time jobs. And as we're kind of starting to build a little bit of a following here, we bought an 8-unit apartment complex. And in the meantime, we were going around building a third-party management company that was managing basically distressed single-family homes that couldn't sell during the recession. We had a portfolio of about 100 single-family homes. We had, we owned a couple of them. We had a couple small multi-deals that we bought with investors. And we were starting to kind of tee up the business to, what do we do now? We were still working our jobs. We're about, 4 years into this. And we were doing some student housing out in Athens. We built some housing. We really just said yes to anything that came along. And in 2011, we really bought our multifamily deal that committed to and said, listen, this is what we're going to do. So we bought a little 11-unit deal in Midtown Atlanta and say, this is going to be it. And in 5 years in the making, we quit our jobs in 11. And in 2012, it really positioned us to break out, and we raised our first multi-millions of dollars and bought our first multi-million-dollar assets. There were about 2 properties in 2012. They were The first one was about 800,000, and we put about $1.5 million into renovating it. And the second one we bought for $2.5 million, we put about $2.5 million into renovating.
Nice.
That now set the stage for 2013, which was really our breakout year, where we bought 9 properties, 600 units, and raised $10 million. It was all the same way that we'd done it from the beginning, which was average investor was giving us $25,000 to $50,000, and we were just making friends and looking for opportunity. And we really just repeated that year after year since then. Over time, we've exited some assets. Over time, we've diversified in other asset classes and other markets. We're in 4 markets now. We're in Atlanta, Chattanooga, Greenville, South Carolina, and Charlotte, North Carolina. We have about 110 full-time people. We have multifamily, mobile homes, and office and triple net leases that we own. And our total portfolio size is a little bit over $200 million at this point. We have about 300 active investors with us, and it's been an incredible ride. We're vertically integrated. We renovate and operate everything we own, and we're still going and blowing and having fun doing it.
Yeah, well, that's pretty awesome. You mentioned some areas that are where my family's from. My mother was raised in Greenville, South Carolina, and my dad had been in Charlotte for a long, long time. And when we were kids, we used to go drive all the way in a bus. I was part of a Scouts, and we were part of the YMCA camp up in foothills of North Carolina. And we would drive all the way to Atlanta to see Hank Aaron swat the baseball, and basically beat Babe Ruth's record eventually. But Athens, I've been all over there. I've taught classes all over Georgia, and including Athens, by the way, great college town, and lots of RAMs from there, the group RAMs from there. But in any case, you mentioned some great areas, man. And it's funny. A lot of people will say, "Well, Atlanta's got an overcrowded, too many investors, or too competitive." And I never, I understand, that people get intimidated because other investors are there, but that doesn't mean you don't invest. That whole area is still growing massively. And you get outside the belt, and North Georgia. I mean, my gosh, it's just like Cummings, Georgia, right on Lake Lanier up there. It's growing like crazy. So just jump into it, do Airbnb, But what I want to do is I want to get back to some of your investments. So let's kind of take it in 2 parts. Part A is the multi-net. So what would you say was a strategy used, or what was the tipping point for you when you started going from the singles up into the multis? Because I know for me personally, that was like, I never look back. I don't even look at singles anymore. I'm not against them. It's just, it's a lot easier for me to manage, 50, 100 unit buildings. It's just a scalable thing, So if you could tap into that a little bit, because a lot of people we're working with, listen to the podcast, are kind of at that point, they're duplexes, triplexes, fourplexes, thinking, gee, Garrett, so-and-so owns a 100 unit building. How do you make that jump? And so if you could tap into that a little bit, Josh, that would help people. And then later on, we can talk about the mobile homes. I think you got some valuable insight there too,
Yeah. So from our standpoint, we're hustlers. We work hard. And what I love, I think one of your questions that you sent me in advance was, what do you love about real estate? It's like, you don't need a college degree. You don't need education. You don't need any certifications. All you need is grit and hustle. And that if we have anything, it's that. So I would say we generally work harder and longer and more consistently and more stably than the average guy that we're competing against. We're very systematic. We're very process oriented, and so we're very much the kind of, I wouldn't necessarily the turtle, because we've moved very quickly, but we're playing the long game. We're not looking to make a quick buck. We're not looking to flip. And what we quickly learned that single family rentals, we could not find a long game that operational model worked in, and also that single family rentals worked as a rental long term, because as soon as the depreciation kicked in on one of your single family rentals, you wiped out your cash flow for multiples of years. Versus multifamily, if you have to replace a roof on a building, you have lots of doors to share that over. Whereas single family is one door. So there wasn't really we didn't think there was a long-term viability model in single family rentals. I don't know if anyone really sees that. I think even the big players that are in the space are into it for a 3 to 5 year run, but not for a 10, 20, 30-year run. Most of the guys we're buying our properties from either built them 40 or 50 years ago or have owned them for 20 plus years. and the patriarch of the family is passing them along to the next generation. The next generation doesn't want to operate it, so we buy it at a discount. In the multifamily mobile home park world, even in the office world too. So from that standpoint, it's just a much more manageable, scalable model for the long game. We're building we say that we're building a multi-generational company that we want to make past the fourth generation. The second generation is pretty easy. It's your kids.
Yeah.
The third generation, you're probably not going to be there for too much of it, and they're pushing you out the door pretty quickly. So they have all the opportunity in the world to destroy what you built. Yeah. And then the fourth generation, if you make it to the fourth one, that's when you really say it's been made. And so that's kind of our philosophy of investing in the angle that we've taken with the deals that we bought. In general, when we buy an apartment or a mobile home or an office deal, we're making investments that will last 10 plus years. Yeah. So if we were looking to flip the deal in a 3 or 5 year horizon, we probably wouldn't spend the kind of money on renovations that we do. So the guys that buy from us love buying from us, and they normally pay up for the assets that we sell to them because they know our investment philosophy, and it gets us higher returns as a result of it in the long term. The short term, it does not. Short term, we are not chasing short term gains.
Yeah. Well, I like the philosophy. And I know for me, when I made the first big jump, I had a whole pile of the small 2 to 4 units, and then about a 5-unit, 9-unit. Well, the next one was a 70-unit apartment complex, and I'm thinking, are they going to take me seriously? Is the bank's going to take me seriously? The answer was absolutely yes. What I found out was banks would rather lend money on the bigger properties than a bunch of little smaller ones. It's just, bigger property is going to take care of itself whether you and I are there or not. It's usually managed. So in any case, it actually got easier, and everything. There's so many efficiencies you can gain when you have more doors per building. So in any case, I appreciate that insight. If you wouldn't mind, let's talk a little bit about the mobile home parks, because for some reason it's big subject this year. I don't know why. It's just for some reason I'm attracting more people that are wanting to are already in the mobile home space all over. I mean, literally, New Mexico seems to be big. Florida's huge, all over Florida, Texas. But if you could talk a little bit about that, like when you first get into it, I know you're looking to exit out of it. And I don't know if it's because you want to specialize on the multis, or if you could tap into that a little, because a lot of people are asking me, what about mobile homes? And I say, well, I don't do it personally, but I know people that do, and we can get you in contact,
Yeah, so we had a very simple investment strategy with mobile homes. It was basically following what we did in apartments, which was get in, buy as many small mobile home parks in a high density area as we can, aggregate them up to get management efficiencies, and exit up with that scale. So for example, we went to Chattanooga and we didn't buy one mobile home park, we didn't buy 2, we bought 7. And we have in the Chattanooga market, we're selling them right now. It's a package of 400 pads. We did the same thing in Charlotte. We did the same thing in North Georgia. So collectively, we have about 1,500 pads worth somewhere between $40 and $50 million. But we paid obviously much less than that, and really a lot of the value creation is that we went in and bought something that was written on the back of a napkin from a person that was that built the park and that didn't have any records or bookkeeping and didn't even report their income because it was all cash to the IRS. We bought it, put professional management in place, professional accounting and reporting in place, and then bought all the adjacent parks so that they're manageable. And then our intentions are to sell those to more of an institutional, larger scale player that wants management efficiencies and stability of operations.
Awesome. Well, I tell you what, you mentioned the 4 areas in Chattanooga, Atlanta, Greenville, Charlotte. I know you're in Texas now, Dallas-Fort Worth area.
No, I grew up there. I left Texas 13 years ago.
Oh, did you? Okay. Well, yeah, by the way, my degrees, and back then we didn't call it software engineering. It was basically an engineering degree, and we wrote operating systems, so we have similar backgrounds there too. But came from, I've basically born in Germany, lived in Pennsylvania, New York, but raised in the South. So if you wouldn't mind, touch a little bit about the geography. So in other words, you're in the area, you can easily get to Greenville, Charlotte, Chattanooga within a few hours. Charlotte's the longest drive, but it's such a massively growing area. But what about other areas some of the tools and strategy you're using? Have you met other people using the same fundamentals in different areas,
Yeah.
New Mexico, Texas, and so talk a little bit about that. And maybe are you looking at other areas and why or why not?
Yeah, absolutely. So, number one, I live in Atlanta. I have 3 young boys, 6, 4, and 6 months
Awesome.
old. So, but by the way, not to go too much on the personal side, but I always give my wife, I consider her my greatest asset. We've been together since we were 12 years old, and she's enabled a lot of the success to happen in my life, in our life. She's really supported me throughout the whole run. So I give her a lot of that credit. But so we moved to Atlanta together, and I was based in Atlanta, but I traveled all the time when I was working as an engineer. Dave was based in DC. He didn't even have a home. He didn't even have an apartment in DC. He just slept on people's couches because he was there so infrequently because he traveled all the time. Yeah. So when we started building the business and things started going well, we said let's start defining what our business is. One of the definitions we said was we're going to operate everything we own, and we want to be able to get there and back in time for dinner. Mm-hmm. Very simple, right? Everyone can visualize that. Everyone can feel that. Everyone knows what that means to them, right? That everyone knows what time they walk home. Everyone knows what it feels like when they walk through the home of their house, and what happens every night when that happens. We wanted to create a culture and an environment for our team members that they would never have to miss that. Yeah. So that was a big part of kind of our geographical areas. So we basically say roughly about a 4-hour driving radius from Atlanta. Yeah. So we looked at that 4-hour radius, and we looked south, and we looked south of us. Mm-hmm. Between I-20 and Atlanta, and I'll say Jacksonville is an exception, but really until you get to South Florida, there's really no population growth or economic growth. Right. Very few exceptions. So we said, listen, let's not waste our time. Let's not look south of Atlanta because you have to go really far south to get anywhere has economic growth. So now let's look east and west. Yeah. The state of Alabama has had negative population growth for about the last 30 years. Mm-hmm. Specifically, Birmingham has been flat or negative for a very long time. And then you go east, and you really just get to the coastal cities that don't have much of an economy. So we really said, what are our major highway drivers? We said 75 and 85. Where do those take us? On the west side, it goes to Chattanooga, and then you can split off in 24, go to Nashville. We would love to get to Nashville. It's too hot of a market to even waste our time with right now. Yeah. And then on the east side, we have Greenville to Charlotte. And then once you keep going north, you eventually hit DC. And 85 is just a monster economic driver. Oh, yeah. So what we did was we followed population trends that basically led to economic trends that basically led to kind of to the primary markets that we're in. Yeah. We think Texas is a great market. It's just not a market we cover. There's no reason other than I can't get there and back in time for dinner in a car. We don't want to be subject to airplane schedules either. So that's the main reason why we don't go to Texas, or we think it's a great market. I grew up there. I know it well. We also wanted to stay out of kind of states that were too blue, like a California, that were really restrictive or overly tenant friendly, because it would just make our jobs as landlords harder. And so it boiled down to really simply, driving radius. If we can't operate it, we're not going to do it, and go where population trends are positive. Yeah, well, I like it. What about Columbia, South Carolina, a good college town? It's just a few hours past Greenville. I think there's a direct route to live. But how is that a shrinking market or stable? Have you guys ever looked at there before? It's a little flat. That market's a little flat. I've gone there way too many times and I've never found anything I liked. What I found in Columbia's the disparity of wealth of Columbia is more extreme than other cities like it. That the so we mostly deal in affordable housing, low income housing. And what we found is that the low income affordable housing in Columbia is a lot lower income and more distressed than the other cities that we're in. And so it's been a tough market for us to make sense of. Okay. So that's why I've looked there a lot. I've probably been there 9+ times looking at deals. I was there 2 weeks ago, and every time I go, I slap myself and say, why am I wasting my time here again? Yeah. Well, the markets you mentioned too, let's face it, Charlotte, you've got some other bedroom communities within a 45-minute drive of Charlotte. In the south, you got Rock Hill. And then same thing with Greenville. You got Spartanburg to the north, Anderson to the south, Clemson. Yeah, we own in Spartanburg. We also own in Rock Hill. I think Rock Hill is one of the most overlooked markets in the country. I think Rock Hill has tremendous potential. So we bought our first asset in Rock Hill in January, and we're aggressively trying to get more, but it's a tight market.
Yeah, and in Atlanta too. Look again within. You got Macon to the south. You got Columbus out to the west, which is a college town. I know it's not big of a market, but it's Columbus is probably close enough. I don't know. Is it?
No, I would never go to Macon. Macon's had negative population growth since 18. I think it was like somewhere around like the late 1800s. It's just been declining population.
Oh wow!
So
okay.
Macon, Macon has a lot of good things going for it. But what it doesn't have is people wanting to move there.
Yeah. Well, it's interesting is wherever we actually just had a webinar last night talking about this very subject, population growth, job growth. So you look at where industries are moving in or expanding, and look at where people want to live, and it'll draw the companies to there. Just like Amazon, perfect example. They're looking to be where people are, where people want to be. So companies are doing that. So it's two go hand in hand. People need to be where their jobs, but now because there's more job openings and there are people looking for jobs, the jobs themselves, the industries, the companies are looking to relocate sometimes in areas where people do want to live. It's like this shift and it kind of goes back and forth. So, but the two go hand in hand. And wherever you have that, you have demand on housing, and housing is a slow moving commodity. Everybody listening, just remember this, one of the things I like about real estate is it is a slower moving commodity. You can track it, you can measure it, you can determine trends. It's easier to move in and out and have some safety. I know people knock and say, well, that's not liquid. Well, I disagree, because if you've got a portfolio and you have an open line of credit like I do, a commercial blanket mortgage is set up as a commercial line of credit, I can tap into funds anytime I want. I couldn't do that on day one, but think about this in the stock market. You can't go to a bank and say, I got $10 million in stocks. Will you loan me $8 million against the value of my stocks? They're going to say no. So in any case, everything that you described are the reasons why I like real estate. Plus, the main thing is this: it's a tangible asset, and you just can't ignore that. It's economies go up and down, and the fact is, all these places you mentioned have colleges and universities, and when the economy drops, college enrollment actually increases. So and think about it, hospitals, even teaching hospitals. People always need medical care. It's a stable, so you can get to the residents, the interns, the nurses as your tenants. So you just can't go wrong with those areas. On topic, there was a chart we looked at last night. The top two industries for stability were higher education and hospital systems. Amazing, not very glamorous, but and you throw in a third. Let's say you throw in high tech or finance is a third industry. You're in great shape, man. Tourism's nice, but we don't invest in the resort areas either, because it's usually the economies are the lower end economies, and they're either the three usually we see are tourism and agriculture, which are two low end economies or markets, and sometimes military. So I'd rather be in a city like Charlotte, where you got high tech, you got medical, and you got higher education. you're just going to have a better deal and make a better way to make money there. So, hey, if we could do this, if you wouldn't mind, we're getting close on time here, but as far as timing goes, like you mentioned, you left your jobs in 2011, which I admire you for. So I know I retired back in 2003 at the ripe old age of 40, and a little bit scary. So, but what you guys did, you did it at the market had bottomed out, and in 2011, that was when it was flat at the bottom. So that took a lot of guts and a lot of courage to do that. And you mentioned, just basically having grit and that hard work attitude. I know most people I've seen succeed, it's perseverance, determination, and just never freaking giving up. But if you could talk a little bit about timing, like when you got started through to today, and if you use timing to adjust your strategies, and use it to your advantage because of what you knew, like how does timing play into this, the success you've had,
Yeah, it's funny. I'm listening to the book Outliers right now. I don't know if you already listened to it, but for your listeners, it's a fantastic book, Malcolm Gladwell.
Yeah.
And I'm on the first 5 chapters right now. I can't remember what chapter I'm on, but the first couple chapters talk about kind of the luck of your birth year and kind of where that kind of puts you, where that kind of lines you up for your success. I've been actually saying this since before I read the book, but people ask, what do you attribute your success to? I'm like, well, someone could say I was just born in the right year, that I graduated college at the right time. I got frustrated with my job 3 to 4 years in, just like everyone gets frustrated with a job 3 to 4 years. That part wasn't unique. Just happened that my frustration happened to be in the middle of a real estate recession, where I could buy things at pennies on the dollar. And the same for me and my business partner. And we were able to, and with our kind of grit and tenacity, with just our general work ethic, we were able to take advantage of that and capitalize it and go as fast as we could at the time. My only, sometimes you'll say, well, you have any regrets? Would you done anything different? I would have just, I don't know if I could have worked harder, but I would have just, the only thing I would say is don't sleep, don't take any time off, and work harder and do more. Because we would have just done that much more at the time. Because that was just the window of opportunity. That it was really an ideal window of opportunity. And Outliers refers to one of the case studies that he does is looking at kind of Bill Gates, Steve Jobs, Steve Ballmer, basically all the tech giants of their era, and they all happen to be born between 1954 and 1957. So were they tech geniuses? Obviously, they had a lot of hustle and grit and all the same things that I had, but they also were born in the right year that the economy was well positioned to realize the fruits of their labor. So, I think I attribute a lot of the kind of the story and the success to that. From a timing standpoint, I don't think Dave or I can see the future. I don't think we're planning or predicting the future. I think we're more looking back at the past and sensing what the past feels like to us. So I would say we were always a little late to the party. Like when we were buying apartment units for $30,000 to $40,000 a unit, we felt that they were too expensive and we should be really, really careful. And we should only buy in really good locations, because not all apartments for $30,000 to $40,000 a unit are good deals. Looking back, that was wrong. All apartments for $30,000 to $40,000 a unit today is a good deal.
Right.
That we would have sold those for at minimum 60, but most of ours were selling over 100,000 units.
Nice.
So, looking at, the bad parts of town that we decided not to even go into, we would have bought for 15 to 20 a unit. And those are now exiting between 60 and 70,000. So the multiples are the same. Like our average multiple has been 4x on investors' money. And we would have just done more of it and not been as cautious. And if we hit another cycle, we'd probably get a lot more aggressive seeing that.
Right.
Now we're playing a lot, we're playing a lot more conservative, playing a lot more defensive. We see something that kind of fits that bucket, we go screaming hard at it.
Right.
But we're looking for more stability and kind of good, solid valuation plays, more so than the giant value add leaps. We're doing that. We're just not doing the volume of it that we had.
Right. Yeah. Well, I appreciate that. I know for me personally, I'm more into asset preservation now. So in the early years, it was all cash flow. I wanted to buy properties and cash flow as much as possible. And over years, and this is what I learned about a lot of really successful investors, is believe me, we still love cash flow. But over time, we're looking more to capital appreciation relative to cash flow. So in other words, like in San Francisco, we know people that are buying with negative cash flow because they know in 5 years that property is going to double in value. And they'll take a hit on cash flow for the first year or so. But also it gives you an opportunities with your tax strategy. So remember, the tax code is written to be used, and there's code in there that allows us, business people and investors, to make the greatest advantage of our assets and the income coming in from those assets. So I guess what I'm getting at is over the years, I've started buying better properties, not A+ luxury, but good solid C+. I mean, even though my cap rate was lower in the beginning than it was years before when I had much more cash flow, the point is I know over time I'll have less headaches and I'll have greater appreciation and less deferred maintenance and stuff like that. And all of that over time just adds up to more peaceful, quiet time. So what I'm getting at here, guys, is the bigger picture is this. What I just described is micro strategy within real estate investing, where between cash flow, appreciation, depreciation, and equity pay down, over the years, in the beginning, you generally shift more towards cash flow in the beginning, but over the years, you start paying more attention to appreciation to preserve your capital, and you still have cash flow coming in. But I guess what I'm getting at is I'm trading, it's parallel with my life philosophy of trading my time for money in the early years to shifting to trading my money for time in the latter years. So now I'm all about experiences with my family and my loved ones. I've been able to see all my loved ones in the last 3 years. We got a big family reunion this next week in North Carolina. Outer Banks, 25 people from my mom's side and my dad and my uncle's side. It's just, I can do these things now, and it drives me forward. That's what drives me now is the trading my money now for time and experiences with my loved ones. And I want everybody to experience the same thing. And so using what Josh has told you, think about what he just showed, what he just talked about, multi-units, mobile homes, and now he's being more selective and being more defensive. And part of it may be cycle timing. We know we're at or near the peak. We don't know how long it's going to last. Could be another 5 years. I'm pretty optimistic, actually. But at the same time, we know enough to know that we don't know. And I've been in 4 major cycles. I don't even get excited anymore. I just learn to expect that it's going to happen. And when you have that sense of experience and knowledge, you don't get flustered, you don't get frustrated, you don't act hastily. You just plan strategically for those eventualities. It does get easier the older you get. So in any case, what you just shared there was actually a really big golden nugget because it has so many other implications. But any final thoughts, anything you can share with people, words of wisdom? I mean, I know we're cut from the same cloth or the same mastermind group, and it really does come down to hard work. But anything you can share, Josh, and if you have a favorite book, another book like Outliers, or a report you've written, or some way people can get a hold of you if you're looking for other investors. I mean, we got people listening to this in 26 different countries, and a lot of them are professional and business owners. So anything you can share as we wrap this up would be awesome.
Yeah. So I mean, our general philosophy is all around the long game, and that there's always money to be made in every market at all times. So if you're thinking that you should wait, I think it's a bad idea. You're really just delaying him. It's just really a bad excuse. It's not always the best time or cycle to hit home runs, but I'll be honest with you, we didn't know we were hitting home runs. We were hitting home runs. We thought we were bunting, trying to get on first base when we were actually hitting home runs. Mm-hmm. So the time is now, not later. Whether it's to buy something on your own, whether it's to invest with someone else, but you can always be building your education as you go, and just make safe bets. Focus on the fundamentals, get back to the basics. Earlier this year, we kind of had a powwow with our leadership team and said, listen, let's just, how do we get back to the basics, focus on fundamentals? Don't chase cap rate. Cap rate's a manipulated number. It's a stupid number. Nobody should be using that as an investment decision. You should be looking at price per square foot, price per unit, rental growth, economic growth. Cap rate doesn't matter. Cap rate's an output of all those inputs. Yeah. Define what your fundamentals are and define them and aggressively move towards them. Our website's greenleafmgmt.com. A lot of information's on there from our management philosophy to very light investment information, but also kind of our stories on there as well. So you can get to know us a little bit more by visiting us there. And don't waste any more time. Time's now.
Yeah. Well, I appreciate that, Josh. So everybody listening, make sure you write that down. It'll be in the podcast notes, by the way, greenleafmgmt.com. Read all about it. If you want to participate in the wonderful Southeast real estate market, you got an opportunity to do it with Josh. And we know each other from the mastermind group. So pretty good mastermind group too. And a lot of the tagline is healthy, wealthy, generous men who seek to lead epic lives. There's a men's group and a women's group. And for the most part, I've been part of that I was one of the first members, honestly, one of the highest grade level of character in almost any group I've ever been involved with. And it's just an amazing experience. And you can certainly participate in these things with us. So again, if you haven't subscribed to the podcast, please do so. It's real estate investing for professional men and women. Go to the myinvestmentservices.com website. There's all kinds of free stuff they give you, books, information, reports. And if you want to join the community, you can also do that there. So I guess, Josh, I think I speak for everyone when I say thank you for taking your valuable time to share your knowledge and your experience with everyone when it comes to the multi-units and the mobile homes and the Atlanta, Charlotte, Greenville, Chattanooga areas. For those of you listening, you got an opportunity here to tap into something that would really help you propel yourself and allow you to position yourself so that when you're ready to retire, you have choices and you're not going to be stuck behind the chair. You can have passive income coming in from tangible assets. You can leverage your businesses to buy these assets. You can leverage the assets to help you grow your businesses. It's an amazing relationship. So Josh, thanks again, brother, man. I appreciate you doing this. I'm going to hit the recording here button. So you guys, we will see you on the next podcast. Take care and God bless you and your families.
Thanks for listening to this episode of Real Estate Investing for Professional Men and Women. Be sure to go to myinvestmentservices.com to join our community and start building wealth today.